So there is another topic of tokenized sovereign debt, right? Maybe we could briefly touch upon it. Um, Stablecoins increasingly influence demand for sovereign debt, as we know it, particularly U.S. treasuries, with research linking stablecoin growth to yield curve effects. How do you see that dynamic influencing the appetite for tokenized real sovereign debt?
This is inevitable. This is an area that I continue to work on. I research. Um, Look, anytime you're in a situation that brings liquidity and efficiency to a market, you can't stop it. We saw this with the advent of the internet. The internet made communications easier. There were times where people would say, well, you can't accept an emailed document as a legitimate document. You got to send a fax. I haven't seen a fax in ages. And it's actually interesting because sometimes I'm in an office and I say, okay, look, I'm ready to sign the documents now. And they'll say, okay, well, we'll just send it via DocuSign. It's easier. So there's actually a preference for DocuSign to wet ink in many instances. Um, and I think sovereign debt is the largest asset class by a significant margin. I mean, I think it is not an underestimation to say that the sovereign debt asset class, as an individual asset class, as a fraction of debt, I think it's like a third of all global debt, and it represents about $100 trillion market per year. And that's at the sovereign level. There's also agencies below sovereigns. Like if you look at a country like Germany, Germany issues bunds at the federal level, but then you have cities like Berlin that are also issuing very high quality AAA rated debt. And the great stablecoin companies like Tether and Circle, they have figured something special out, particularly Tether. I mean, at any one time, I think Tether now is something like the 17th largest holder of treasuries, US treasuries in the world. And they are definitely one of the largest holders of gold reserves in the world. Tether is basically a virtual central bank. It's a virtual and private central bank. And in many instances, and this is the market speaking, it's not me opining, in many instances, in many countries, the citizenry trust Tether more than they do their own central bank. I mean, if you think of it, there are many, in many countries, they're far more interested in accessing USDT than they are in holding their savings in the native currency issued by the central bank of their country of citizenship. So when you look at it, you have basically outsourced central banking activities to a company like Tether. Um, Now, the tokenization of debt, this is something that is also near and dear to my heart. The entire Web3 blockchain tokenization argument, we have to remember it's just technology. It is technology designed to speed up the transfer of assets, to create more efficiency. And with more efficiency, you should have more transparency and more liquidity. So instead of it taking T plus 2 to settle a trade, you can now settle a trade in T plus 0, right? So when you look at something like this, it's clear to see that this movement is not going to stop. It's a matter of, are the regulatory environments going to be intelligent enough to keep up with these changes, or will these changes just carry on either underground or in from jurisdictions that are quite proactive or advanced whenever it comes to permitting such activities? But without a doubt, I think that it's going to create a lot of liquidity. Right now, the US market is the prime benefactor, but in the same vein, when something is very easy to buy, it is also very easy to sell. So like it's a bit of a double-edged sword because liquidity can work in both directions.
Mm-hmm. And what are the key regulatory and technical enablers necessary for sovereign debt tokenization to become investable by institutional clients?
Yeah, well, I think Tether has sort of proved that it doesn't necessarily need a lot of regulatory approval to make this stuff happen. What it needs is people to trust that what it's doing is effective. But this hews back to my original statement. The beauty about blockchain is it is largely trustless. If you're willing to take the time and you have a good chain explorer, you can actually get a good sense of what is happening on chain. If tokens have been minted against real assets, particularly if the entity has proof of reserve or not. I mean, we as DeFi technologies, we have led in, or we have invested in, we didn't lead the rounds, but we were part of rounds as significant investors in the CNGN Nigerian Naira stablecoin, and also the QCAD from Stablecorp, which is the Canada's first regulated Canadian stablecoin. And the work that these entities put into providing proof of reserve, tracing transactions, KYC, AML, and making sure that their stablecoin products are reliable, I guarantee you that the average citizen has more transparency of how currency is issued with stablecoin issuers than they do trying to figure out M1, M2 liquidity of the US dollar, examining the linkage between the issuance of central bank backed sovereign debt and central bank backed currency. And I should correct myself because the central banks don't issue the sovereign debt. They sort of execute on policy. Normally, it's a Ministry of Finance or the Treasury Department that is responsible for the issuance of the sovereign debt, but then monetary policy flows from the sovereign debt issuances. But the correlation between the two is not necessarily one to one. Whereas the correlation between the marketable securities that stablecoin issuers hold and the issuance of the stablecoin is frequently one to one. And when it isn't, when there's a fracture between that peg, we see it almost immediately. You look at something like a Luna. We all recall that. It caused such massive disruption in the market. We're able to see that. Same thing when Silicon Valley Bank was having liquidity issues. Their liquidity issue was an asset liability management issue associated with the duration of the assets on their books, which were too long, versus the liquidity requirements of their depositors. And by and large, depositors have short term liquidity requirements. Now, in the case of Silicon Valley Bank, it turned out that Circle had a lot of short term liquidity requirement um, deposits held at Silicon Valley Bank. But everybody knew that. There was good transparency about that. And the fault was not Circle's because when you put your money with a bank, the assumption is that it's liquid. The fault there was with the traditional banking system that did not do proper duration matching associated with their asset and liability management. So, in many regards, I think stable coins are again another one of those killer apps because they're actually more transparent than what happens with our current monetary supply, in which case governments can issue more money, more fiat currency against the securities they have, which results in inflation. And you don't figure it out until many quarters afterwards because it's tends to be a lagging indicator.
How do you address concerns from institutional audiences that digital asset products, even regulated ones, may not yet have the robust investor protections they expect compared to traditional capital market instruments?
Honestly, I address that concern in this way. I think most regulators don't know how to code. And because they don't know how to code, or they're not necessarily mathematically inclined, they tend to be afraid of those things they don't understand. Back in the day, and I'm sure you'll recall, the argument was that digital assets could give rise to money laundering more easily than cash. And that to me was always shocking because you know, and I know that you can trace almost every transaction on chain almost right back to the genesis block of the transaction. So I think the concern is, and I've often said this, the biggest concern is there's confusion as to how you tax this stuff. And I think anytime that there is confusion about taxation, the default is to basically say it is bad, to sort of scare people away from the asset. Same thing happened with internet commerce. Back in the day, there was always concern about, oh no, it's not safe to transact over the internet. It was always, you could send an email, but you've got to like do the transaction offline. Right now, in many instances, it's considered safer to transact online than it is to transact offline. And I think eventually, as more people become familiar, just like with stablecoins, there's more proof of reserve technology and transparency with stablecoins than there is with the Fed. And this is a fact because we don't know on what basis the Fed is making buybacks. And I say the Fed, the US Federal Reserve. The US Federal Reserve is making buybacks, issuing paper. It's hard to match. If you go to treasury.gov and you try to track this, it's actually quite confusing. But whenever you try to track, for instance, I was looking at the transaction history and minting records and transaction volumes of the CNGN stablecoin in Nigerian Naira. It is so transparent. They can tweet it out. They have a dashboard on their website. And certainly Tether, Circle, QCAD, all other stablecoins that are legitimate have similar functionalities and operations. So I think it's actually a lack of understanding and a lack of appreciation of the strength of the technology.